of accounting says that we record revenue when earned and expenses when incurred to generate revenue. So there's a pairing, a matching between revenue and expense. This is the recommended method of accounting. The cash basis, on the other hand, says we don't record revenue and expenses until cash moves and are out, not recommended. So to explain the difference, let's talk about a few basic transactions. So first, let's say payroll. Let's say that on 12/31, you owe employees $3,000 in wages, and you're going to make that payroll payment on January 5th because that's when the next payroll date happens. Most companies pay payroll 26 times a year, every other week. So the accrual method says that on 12/31, we're going to debit wage expense, we're going to credit a liability account called accrued payroll. Both of those are for $3,000. Then on January 5th, when we actually make the payment, we debit to remove the accrued payroll entry, so now it's zeroed out, and we credit cash $3,000. So what we've done is get the expense into the year at 12/31, even though the cash didn't move to the following year. Under the cash method, we would not record any expense on 12/31, and on January 5th, when we make the payment, we would debit wage expense and credit cash for $3,000. That's incorrect. It's not good accounting because the expense is in January. It's not recorded in December. So that's payroll. Let's think about a sale on credit. So we sell something to a customer on March 25th, and the vendor pays us on April 6th. So we sell it March 25th, the vendor pays us April 6th. So on March 25th, under the accrual method, we're going to debit to increase accounts receivable. We're going to credit sales or revenue. So we get the revenue in March. And then when the customer pays us in April, we're going to remove accounts receivable by crediting it, and we're going to debit cash. So we got the revenue in the proper period when we made the sale, which was March. Under the cash method, no entry in March at all. We only make an entry when cash is received. We debit cash, we credit revenue. Problem is, we've got revenue in the wrong period, April, instead of March. One more transaction, that is buying something on credit. So accrual method, let's say we debit office supplies, we credit accounts payable in 1 month. The next month when we pay the bill, we remove the payable by debiting, we pay out cash, credit. We get the expense in the right amount in the right period when we made the spending. Cash method doesn't make any entry. That first entry doesn't happen. The second entry is when we pay cash, we recognize the expense, we credit to reduce cash.